Planning Association. Today is August 17th, 2017, and I'd like to welcome you to our Retirement Planning Knowledge Circle with FPA. With that, I'm going to hand you over to one of our hosts, Betty Meredith. She's going to do the introductions for today's speaker. Thank you, Betty.
All right. Very good. Thank you. So I'm so pleased to have the honor to introduce Denise Appleby. I've known Denise for many years, and she is the CEO of Appleby Retirement Consulting, which is a firm that provides IRA tools and resources for financial and tax professionals. She has over 15 years experience in the retirement plans field and has co-authored several books and written over 400 articles on IRA rules and regulations, and aren't we glad there's somebody like her out there. Denise is also the CEO of the consumer website that provides free information about IRAs called retirementdictionary.com. Denise has held several senior retirement plans related positions with Pershing LLC, including Vice President of Retirement Plans Products and Services, Retirement Plans Manager, Training Manager, Compliance Consultant, and Technical Help Desk Manager. She has extensive experience training staff and financial advisors of many broker-dealers on retirement plan related topics. And she also provides training to hundreds of financial advisors as well as tax and legal professionals on rules and regulations that govern IRAs, SEP IRAs, simple IRAs, and qualified plans. And Denise's wealth of knowledge in retirement plans has led her to make appearances on CNBC, Fox Business News, and other numerous radio shows, as well as being quoted in the Wall Street Journal, CBS Market Watch, Retirement Weekly, and other publications. And her expertise and knack of explaining complex retirement plans, rules, and regulations so that they're easily understood created demand for her to speak at various conferences and seminars, and that's how I got to meet her. So thank you so much, Denise, for being here today, and I'll turn it over to you.
Good afternoon. Thank you. And every time I hear you talk about me, I say I need to hire you as my publicist because you make me sound so great.
But you are.
Well, today I want to talk about something that I've found to be very important to my clients. As of now, the ICI has reported that there's $26.1 trillion in retirement savings accounts. And as you can see, the market's doing well. Retirement accounts are looking great. And usually when I have conversations with my clients, the conversations are about how great those accounts are doing. But unfortunately for me, unfortunately for my clients and their clients, the majority of my clients come to me because mistakes were made, whether by themselves or by the clients, and they're trying to help me fix those mistakes. And sometimes I can get those mistakes fixed. Sometimes I can't. And for those that can't be fixed, it's very costly for the client. So if you're a financial advisor and you've been working with a client and the client's account has been doing great, that's good. But then if you have to have a conversation with a client that says, that account that I've been working with you on for years, that is now up 30%, well, that account that you thought is an IRA is really not an IRA and hasn't been for X amount of years. And what that means is, let's assume that the IRA wasn't an IRA in 2010. You should have paid income taxes in 2010. And because you didn't, you know our penalties. And because the funds are still in an IRA, you actually owe a 6% excise tax for 2010 and every year since that. So that's why I wanted to talk about this topic today. What are some of the things that we can do to help protect those retirement assets that your clients have saved and that you have helped them to grow? Now, what are some of the consequences of mistakes? Loss of tax deferred status, right? As I said before, you're working with a client, the client thinks it's an IRA because they're getting a statement every year or every month that says it's an IRA, right? but it's not. And I'll talk about some of the examples that could cause an IRA to really not be an IRA technically anymore. Premature taxation, early distribution penalty, excess accumulation penalty, and excise taxes. Now, you should be very worried by now if you're not already familiar with this, right? And so you should be asking yourself, what are some of the things that I can do to make sure that my clients are protected? Because I think we'll all agree that none of us want to be having that conversation with our clients, right? So the first one I'm going to be talking about is the 1 per year rollover rule. Now, this only applies to distributions that are made from one IRA and roll over to another IRA. Now, here's how this rule works. Typically, when assets are distributed from an IRA, that amount is treated as ordinary income unless an exception applies. One of those exceptions is if the distribution is rolled over to the IRA within 60 days after the IRA owner receives the distribution. Now, part of what Congress said when they were creating the IRA rules is that the IRA is not a piggy bank. It's not somewhere where you can go to get a loan, right? It's intended for your retirement. But there are some exceptions where they'll say, okay, you can take money from your IRA, but there are going to be consequences. And there's one exception where they said, if you take money from your IRA, it's not taxable, it's not treated as income, it's not subject to the 10% early distribution penalty, as long as you put those funds back within 60 days of receipt. Now, if you've been in this business for, let's say, 5 years, you probably remember that IRS publication 590 used to say that if someone had 2 traditional IRAs, for instance, that person could do 2 60-day rollover. So they could take a distribution from IRA 1, roll it back to IRA 1 within 60 days, and they could do the same thing with IRA number 2 the next day if they wanted to, or the next month. Well, a few years ago, there's this landmark case, and this was actually a tax attorney. So, you know, if this mistake is being made by a tax attorney, you can imagine what the rest of us thought, right? But it's not really his fault 100%, because he did check the IRS publication, which is publication 590, which confirmed his thinking. And also, every IRA agreement on the street had that same interpretation, which is you can do 1 60-day rollover per IRA during a 12-month period. And so that's what he did. And this is the name of the case that I have here on the slide. He had several IRAs. He took a distribution from one, rolled it back, took a distribution from another, rolled it back. Then the IRS got the reports that a custodian usually gives, which is the 1099-R and 5498. And someone said, oh, this doesn't look right. How come this person is doing 2 60-day rollover during a 12-month period? Now, remember I said if that distribution is rolled over, it's not treated as income, right? So he didn't include it as income on his tax return. And the IRS amended its tax return to say you have to include this as income. Now, because the amount was not eligible to be rolled over, that amount that he thought should be in his IRA wasn't eligible to be in his IRA anymore, so it would have been taxable to him. And of course, he disagreed with the IRS. He took them to court, and he lost because the tax court looked at the tax code and said, the tax code says you can do this only once every 12-month period. And on appeal, he said to the tax court, but I looked at IRS publication 590. It said I could do it. I should not be penalized. And the tax court said, well, if you rely on an IRS publication, you do so at your own peril. Can you imagine that? The publications that are issued by the IRS, they're telling us you can't rely on those. You have to go straight to the tax code. So the lesson here is, when you're meeting with clients who want to move assets from one financial institution to another, encourage that they use a trustee-to-trustee transfer method. And with that method, the transfer is initiated by the receiving financial institution. And it's a non-reportable transaction, so it's not reported on their tax return. And they can do transfers all day, 10 times a day if they want to, right? There's no 60-day deadline to contend with. There's no one per year rollover rule. The 60-day rollover rule is another one. I've seen so many instances where people with good intentions say, I'm going to take a distribution from my IRA. I can't afford the income taxes. I can't afford the penalty. Or I really want this to remain in my IRA until retirement. So I'm going to put it back within 60 days. And that's what you plan to do. And then life happens, right? So what happens if someone misses the 60-day deadline? If someone misses the 60-day deadline, that amount is no longer eligible to be deposited to the IRA unless they qualify for one of the exceptions to the 60-day deadline, which includes going to the IRS for a private letter ruling. And in that case, you're talking about a $10,000 fee because that's what the IRS charges, whether or not they give a favorable ruling. There are some exceptions, though, and I encourage you, if you're meeting with a client who says, I missed my 60-day deadline, what am I supposed to do? Part of what I want you to do is check to see if they qualify for any of the exceptions. Exceptions include if they gave you the check and you forgot to put it in the IRA or you put it in a wrong account, then there's an automatic extension up to a 1 year. There's also a self-certification method. And if you have questions about that self-certification method, you can just send me an email and I'll send you information on the details. Spouse beneficiary, I talked about the amount of assets that are in retirement accounts, and of course, there are going to be many of those accounts where the owner dies and leaves it for a beneficiary, right? And in many of those cases, the beneficiaries will be their surviving spouses. Now, this is another thing that I want you to be careful about, and I'm hoping you're making a checklist as we're having this conversation. If you meet with a client who says, I just inherited an IRA from my spouse, what should I do? Now, as a spouse, the spouse has several options. The spouse can, let me just say her instead of him or her, just to make the conversation flow smoother. The spouse beneficiary can put it in her own IRA, or she can keep it in an inherited IRA. And for you as the financial advisor, the question is, how do you advise that client? And in order to make that determination, you're going to ask the client a couple of questions. How old are you? If the client's under age 59 and a half, then the light bulb must go off to say, if she takes a distribution, it's going to be subject to the 10% penalty. Well, possibly, right? How can I avoid that? So the next question is going to be, do you plan to take distributions before you reach age 59 and a half? And if the answer is yes, then at that point, you want to encourage that spouse beneficiary to keep the assets in an inherited IRA instead of putting it in her own IRA. Why? Because distributions from inherited IRA, some refer to it as beneficiary IRAs, are automatically exempted from the 10% early distribution penalty. I included a case here. This is one of those cases where they say a little knowledge is dangerous. And when your clients tell you that they don't need you because all the information is already out there on the internet, these are some of the cases that you can use to convince them to say, you need me not just to manage your investments, but to ensure that your retirement assets are protected, right? In one of these cases, Peggy and Sears, she did some research and she knew that as a spouse beneficiary or as a beneficiary period, she was eligible for an exemption to the 10% early distribution penalty, right? So she transferred her husband's IRA to her own IRA, and that's where she made the mistake. Why? Because if the assets remained in an inherited IRA, distributions are reported as death distribution, code 4 on the 1099-R, which tells the IRS that, hey, this distribution is exempted from the 10% early distribution penalty. But she made a mistake of transferring the amount to her own IRA, mixed it up with money that she already had as her own. Now, when a spouse does that, the assets loses the inherited or beneficiary flavor. It now becomes her money, just as if she had made the contributions from the beginning. So when she took the distribution, the custodian issued a 1099-R with a code 1, which says to the IRS, hey, this distribution is subject to the 10% penalty. She's thinking it's not subject to the 10% penalty, so she does not pay the penalty on her 1099-R, on her tax return. IRS says, Peggy, you owe me money. She says no. She takes them to court and she loses. The lesson here is when you're having the discussion with a spouse who inherits retirement assets, consider whether or not they need to keep those assets in an inherited account, which might be recommended if they're under age 59 and a half. Another good one here is check exception by plan before rollover. And what I mean by that is, I'm sure many of you are aware of the fact that distributions that are taken before age 59 and a half are subject to a 10% early distribution penalty, but there are some exceptions to that, right? And here's where you need to be careful. Not every exception applies to every type of account. Some applies to both employer plans and IRAs. Some applies only to IRAs. Some applies only to employer plans. And by employer plans, I'm talking like 401ks, pension plans, and so on. Another case here where this gentleman, he qualified for what is referred to as the age 55 exception. Now, under the age 55 exception, if you have money in, say, a 401k plan, and you take distributions before you reach age 59 and a half, the amount is exempted from the penalty if you separate from service in the year you reach age 55 or later, and the distribution occurs after you separate from service. So he's thinking, you know, I did my research, I know what to do, I don't need a financial advisor, I'll take care of everything on my own. Takes the money from a 401k, rolls it over to his IRA. I'm sure you're seeing where I'm going here, right? Then he takes the distribution from the IRA, custodian reports it with a code 1 that says to the IRS, this amount is subject to 10% early distribution penalty. He didn't pay the penalty, challenged the IRS when they asked for it, took him to court. And I know you can almost finish this for me because you know what happened, right? The tax court said, you owe the IRS that 10% early distribution penalty because the minute you roll those assets over to your IRA, it lost the 401k flavor and it therefore was no longer eligible for that exception. It cost him $20,000, right? How could he have avoided this? By taking the distribution straight from the 401k and having it paid to himself. So the lesson here is when you're having that conversation with clients about moving assets between retirement accounts, part of what you want to look at is it going into one different type of account, from one different type of account to another? Is it going from a 401k to an IRA or vice versa? And if so, is the client losing any benefit as a result of that rollover? So you want to take that into consideration. Meet RMD deadline. December 31st is coming up. Many of your clients, those who are at least age 70 and a half this year, are subject to the RMD rules, which means the IRS is saying you've been deferring income taxes for all your life, now you're age 70, I want my money. And how does the IRS get their money? They make sure that individuals start taking distributions once they reach age 70 and a half. Now, this is referred to as a required minimum distribution. Now, there's special formula that must be used to calculate the RMD, special rules that apply depending on the type of account. And before I forget, RMDs apply to every type of account for the account owner except Roth IRAs. In all other cases, RMD applies to beneficiaries for every type of account. So what happens if a client misses the RMD deadline? Well, the penalty is very steep. You're talking about a 50% excess accumulation penalty. Imagine having that conversation with a client to say, you know, your $10,000 RMD that you didn't take. Not only do you still have to take it, and when you take it, you're going to owe income taxes, you also owe the IRS a 50% excess accumulation penalty. But I have good news for you. The IRS has a process by which they'll waive that penalty if the deadline was missed due to, they call it reasonable cause. So if your client can say, well, this is my first RMD year, or my broker didn't tell me, or whatever good reason that could be defined as reasonable cause that caused them to miss the RMD, then the IRS will waive the penalty. And in order to get the IRS to waive the penalty, they should file IRS Form 5329, attach a letter of explanation, attach a copy of a statement proving that they have rectified the RMD shortfall by taking the amount that's due. So that's the good news here. You want to make sure if you're helping your client with that, of course, you're going to refer them to the CPA, and the CPA should fill out the form correctly. In my experience, there's only been one instance where the IRS refused to honor the waiver of the penalty, and that was because the CPA didn't fill out the form correctly. And once I helped them to fix that, then the issue was taken care of. RMD aggregation rules. Now, here's a good thing about RMDs. If your client has 2 traditional IRAs, they can calculate the RMD separately, and they can choose which IRA to take it from. You might want to have them do that for whatever reasons. Maybe they want to draw it on in one account. Maybe one account is doing better than the other, and you don't want to disturb that account. But the rule to remember is that this RMD aggregation is not permitted in all cases. If someone has multiple traditional SEP and simple IRAs, then the RMDs for those can be aggregated. If they have multiple 403Bs, the RMDs for those can be aggregated. RMDs cannot be aggregated for someone who has, say, 2 401Ks on the different plans, and they can't be aggregated across account types. So if someone has a traditional IRA and a 401K, the RMD aggregation for that is not allowed. And if that's attempted, then it means that the RMD for one account wasn't really taken, right? So if someone told you, I have a 401K and I have an IRA, and they took the RMD for both only from the IRA, then the RMD for the 401K hasn't really been satisfied. I know you're looking at a 50% excess accumulation penalty. Now, in cases where RMD aggregation is allowed, you want to make sure that the RMD is calculated separately. And that's because in some cases, different formula or different factors can be used to calculate the RMD amounts. Move inherited IRAs via the transfer. I'm going to tell you that this is the #1 mistake that I see with inherited accounts. Because, you know, someone might have their account with Tom Jones at firm A, right? And they die, and their children don't like Tom Jones at firm A. They like you, right? So they want to bring the account to you, and they're happy, so they run to firm A. They say, give me my money. Firm A writes them a check, and they come to you with that check and say, I want to put it in my inherited IRA. And you're at that point, you should be looking at them with horror to say, but you can't do that. It's an inherited account, and unless you're the spouse, once you take a distribution, that's it. You cannot put it back in an IRA. There are so many cases where people attempt to do 60-day rollovers with inherited accounts, only to find out that those amounts are not eligible to be rolled over. Now, I'm going to quickly summarize this case. I'm telling you, you can't make this stuff up, right? This woman inherited 2 IRAs from her aunt, and she had the discussion with her husband. They did the research, and they agreed, you know, she doesn't really need that money right now. Why take a full distribution? Let's keep it in an inherited IRA and take a little bit every year she's allowed to do over her life expectancy. She goes to 2 different banks and say, I don't want a distribution, I want a transfer. And the rep at the bank is nodding their head saying, I get you, I understand, sign this distribution form. So she gets that distribution form. Both banks, I kid you not, gets a check, takes it to the other financial institution, put it in an account, and she's thinking everything is fine until the IRS contacts her to say, I have these 1099-Rs and I don't see that amount on your tax return. What's going on? And she says to the IRS, well, I don't owe any income tax because I transferred it. The IRS said, well, you didn't do a transfer. You took a distribution and you did a rollover. And as a non-spouse beneficiary, you are not permitted to do that. And there's nothing you can do to fix it at this point. So as you can see from this slide, it cost her a whole lot of money. What's the solution to this? If you're meeting with a client who's a non-spouse beneficiary, let them know that unless they really want to take a distribution now, they have to move those assets as a trustee-to-trustee transfer. And the safest way to do a trustee-to-trustee transfer is to have the receiving financial institution initiate the transfer and have the assets delivered directly from one inherited IRA to another. Reconversion too soon. The market's doing well right now, so you might not have an issue with this, but there are exceptions to every rule, right? Now, what's important about this rule? If someone did a conversion last year and or earlier this year and came to you and said, you know what, I did a conversion for $100,000. I'm looking at my account now and it's gone down to $50,000. I have this tax bill for $100,000. I'm looking at an account that's worth only $50,000. I don't think it's fair that I should pay income taxes on money that I no longer have. And you're thinking, I agree with you, let's fix that. Let's recharacterize that conversion by putting it back into the traditional IRA. Because as you know, a conversion means you move money from a traditional to a Roth, right? So you can recharacterize that by putting it back in the traditional IRA as long as it's done by the individual's tax filing due date plus any extensions available. So the client recharacterizes the amount, puts it back in the traditional IRA, which means it's like it's never happened. There's no tax bill. Now the client's saying, the market's going to go back up. Why not convert that amount that's now $50,000 to my Roth IRA so that when it grows in my Roth where the earnings are eventually going to be tax-free, right? And you're thinking, yes, let's do that. But before you do that, you got to hang on and say, hold on a second. You can't do that yet because the IRA, the regulations, and the IRS agrees, say you cannot reconvert an amount before the later of January 1 of the year following the year in which the conversion was done, or 30 days after when the recharacterization was done. So you got to, for clients who want to do recharacterizations and reconversions, just check to make sure that they're not breaking this rule, because if they do, then the reconverted amount is not really a conversion after all. It's just a distribution and a contribution to the Roth IRA, which is subject to a limit of $5,500 plus $6,000. So if they do that, especially let's say it's $100,000, you're talking about an excess contribution of almost $100,000. That's in a Roth. That's not eligible to be there. That's going to be subject to a 6% excise tax for every year it stays in the account. I hope you're adding these items to your IRA checklist. I firmly believe in checklists. There are a lot of things that you need to go over for each transaction that you're discussing with a client. 72T rules. We talked about, or I talked about distributions being exempted from the penalty in certain cases. Distributions taking on the 72T program is one of those. This is subject to a very strict set of rules. One of the things I want to encourage you to do if a client comes to you and say, I hear about this 72T program, some call it a SEP for Substantially Equal Periodic Payment Program. If you're going to advise your client on doing that program, check to see how old they are. I know you're going to do that, but you're going to ask yourself, is this suitable for my client? Because these have to continue for 5 years or until the IRA owner reaches age 59 and a half. So if you're talking to someone who's age 40, that means continuing the payment for 19 years, right? And so the question becomes, if this is a short-term need, is it better for the client to just pay the 10% penalty and suck it up, or lock themselves into this program for such a long period over which they could really deplete their retirement savings accounts and be forced to take distributions during years when they really don't need to? So you're probably thinking, can they just break the rule in the middle of it and say, I don't want to do this anymore? Well, they could. But the question then becomes, what are the consequences of doing so? If you break that program during the mid-year, if you do anything like making a rollover of the amount, doing partial transfer, commingling the assets with other IRAs, so you transfer one IRA into another, or taking less or more than the required amount under the program, then you have what is referred to as a modification. And when a modification occurs, the IRS says, you know what? See all those years that I waived the penalty for you? That doesn't apply anymore. You have to go back and pay me those penalties plus interest. The lesson here is, first, check to make sure that the client is suitable for this program. And if the client is, check all the boxes to make sure it's done right, and give the client a checklist to say, these are the rules by which you need to abide so that you're not considered to have modified your SIMPTE 2T program. And my final rule is beneficiary audits. I know all of you will agree with me that this is very important. If this is not done, then let's call it the wrong party will inherit the assets. I'll tell you quickly about a case that happened in New York where this woman started working at about age 20. And she wasn't married at the time, so she named her mom, her uncle, and her sister as her beneficiary, right? Then she got married and failed to update the paperwork. I think they were married for like 30 years or something like that. And as you know, when two people have been married that long, it's a what's mine's yours and what's yours is mine sort of thing, right? If I'm saving in my retirement account, then it's for our retirement. And if you're saving in yours, it's for our retirement. If you die, I get yours, and if I die, you get mine. So because she failed to update the beneficiary form, that didn't happen. So when she died, her surviving spouse went to claim the assets only to find out that her sister, who was the only surviving of the beneficiaries that she had named, had already taken the $1 million that he thought he was going to get. And he's thinking, but I'm her husband, I should get it. And this was a school district, it was a non-ERISA 403B, and the school district said, you know, I sympathize with you, but her name was on the beneficiary form, she's the beneficiary. See, the rules are different. Had it been a 401k, it would have been a different story because those are subject to ERISA, but this is a non-ERISA 403Bs, and the same thing could happen with an IRA. So he ended up losing $1 million. She didn't give him a penny, and there was nothing he could do about it. What I want to encourage you here is every time you meet with your client, say once per year, or if there's a life event such as a death, a divorce, a remarriage, something like that, remind them to update their beneficiary designation forms. I'm seeing too many real life cases, too many private letter ruling requests, too many court cases where people are challenging who has actually inherited those accounts because everything else pointed to the fact, except the beneficiary form, everything else pointed to the fact that one party should be the beneficiary. Now, one of the things you can do as well is to check for default provisions on the IRA agreement. What happens if someone doesn't name a beneficiary? Who becomes the beneficiary then? Then that's determined on the default provision of the beneficiary form. Check to make sure that when your client names a beneficiary, that beneficiary is a designated beneficiary. A non-person, such as a charity or an estate, can't be a beneficiary. Do not have your client designate as per will as beneficiary, because that doesn't work. That's invalid, which means no beneficiary is named, or if the estate is the beneficiary, the person inherits the IRA through the estate, which really doesn't make them the beneficiary and strips them of the favorable tax benefits that are usually available to a beneficiary. So check those forms at least once per year, please, and after every life event. And unfortunately, I have only 30 minutes here, but trust me, we could spend hours talking about the type of mistakes that could cost your clients their IRAs. And I tell you, it doesn't matter how great a job you've done with the investment, when you have to sit across a client at a table and say, you know, I'm sorry, but your IRA is really not an IRA. That cannot be a pleasant conversation, neither for you or for your client. And one of the ways you can prevent this from happening is by creating checklists for every transactions that you discuss with your client, and give them a little something to say, these are some of the things that we talked about. Make sure that before you do any type of transactions, you meet all these rules. That is my time. Thank you for listening, and I'm hoping you guys have a whole lot of questions.
Thank you, Denise. That's great. I'm muting everyone now, so if they'd like to jump in on the conversation, you can either put things in the chat space or feel free to just jump on and use your computer microphone, or if you've dialed in, to use that number as well. we'd love to have you join the conversation. Rosa says, great presentations. I'm just looking to see if we have any questions or comments. I am unmuting you, so if for some reason you need to be remuted, go ahead and feel free to do so.
I think I scared them too much. You know, I want you guys to know that everything that I talked about was just a high level, because as I said, we had only 30 minutes. Any one of those topics that I talked about, I could talk about that alone for 30 minutes. So this is just something to say, I need to be aware of this. So when you're sitting across from that client, something should go off that says, maybe it's not as cut and dry as I think. Maybe there's something else that I need to think about, because I'm going to tell you something. I'd say for about 90% of the mistakes that come across my desk, these were mistakes that were made by well-intentioned financial advisors. It doesn't matter how simple the rule might seem. Breaking a simple rule could be very costly for your clients. So, you know, I just want to say that light bulb should go off, and be comfortable enough with your client to say, this looks good, but let me take some time and check it to make sure that everything is right, because I want to protect you. I want to protect your IRA assets for you and your beneficiary.
Denise, we have a couple of questions. Betty wanted to know, please clarify ERISA accounts, such as, you know, type of accounts, are where spouse automatically is beneficiary, and non-ERISA accounts are, and then please name a type of account. She was wondering if you could elaborate.
So it's a 401k or pension plan, that would be an ERISA account. Usually for those accounts, the spouse is automatically the beneficiary, and the sole primary beneficiary, unless the spouse gives consent for it to be otherwise. There are some narrowly defined exceptions. Some plans may say, if you have been married for less than a year, then that automatic rule doesn't apply. The key is, if you're having that discussion with a client, have them check the plan document, or preferably the summary plan description, which is supposed to be written in English. and that will tell you what the rules are that apply to that particular plan. But never make an assumption. Always check to make sure.
And Rosa had a question as well. Can a person delay taking RMDs if still working after age 70?
Great question, Rosa. And Rosa, you'll find that for most times that you ask me a question, I'm going to say it depends, because there are always exceptions. Now, for the question that you asked, if it's an IRA, SEP IRA, simple IRA, the answer is no. The answer is also no for a solo K or individual K, you know, that those 401k plans that are adopted by self-employed business owners. Why? Because you can defer your RMD past age 70 and a half only if you're not a 5% owner, and only in an employer-sponsored plan such as a 401k or a 403b. But I want to caution you as well, that is permitted under the tax code. It's not always available on an employer plan. So even though the tax code says in a 401k plan, if you're still working, you don't have to take your RMD, you can defer past age 70 and a half until you retire, the plan could say, you know, that's all fine and dandy what the rule says, but we don't want to abide by that rule. You got to start taking your RMDs. So check with the plan to make sure. No more questions?
I know they're very quiet today. I see Steve is typing. Hopefully, do any of our hosts have questions, or anybody that's dialed in, if you had any comments, if you wanted to just speak directly to Denise, you're more than welcome.
Yeah.
You don't have to let me hog everything. We've got Betty on again. Betty says, are there any other big mistakes you regularly see when advisors encourage clients to roll out of their ERISA plan or other plan like a 457 or 403b? In what ways might a client be worse off tax-wise?
Ooh, excellent question. I always say to my clients when they ask me about rollovers from employer-sponsored retirement plans, because, you know, they usually call me and say, Denise, my client wants to roll over 401k to an IRA. Can they do it? Clients say the client's retired and they want to consolidate their accounts. Can they do it? The answer is, it depends, or it's yes with a caveat. And I always encourage my clients who are financial advisors to get a copy of the account statement, right? Well, first thing is, if the client's at least age 70 and a half and RMD is due, so you want to take the RMD before the rollover, not after. And that's because for any year in which an individual is supposed to take an RMD, the first distribution from that account counts towards the RMD, and an RMD is not rollover eligible. You also want to check with the plan to say, my client has X amount in their 401k. Is all of it rollover eligible? Because they're supposed to tell you. And for amounts that are not rollover eligible, those amounts can't be rolled over. Also, look at the statement to see if there's any after-tax balance, because if there is, there's an opportunity for the client to roll over those amounts to a Roth IRA, tax-free Roth conversion, right? Because, there's this long debate going on about whether or not a Roth conversion makes sense, and you got to do a Roth conversion analysis to determine suitability. But this is one of those cases where it's pretty clear that it should be done. If the client's going to roll over after-tax amounts, why not roll it to a Roth? It's a tax-free conversion, and the earnings are eventually going to be tax-free, as opposed to rolling it to a traditional IRA where the earnings are only tax-deferred. And the next big one is check to see if the client has employer security in that account. Because if they do, and there's significant growth that occurred on those securities while it was in the account, that's called net unrealized appreciation, they could be eligible for a special tax treatment on those net unrealized appreciation that results in them paying less income taxes than they would had the amounts been rolled over. Now, that's not always true, though. Like with anything else, you're going to perform an analysis for the client to see if the NUA strategy is suitable, or maybe if it is, it doesn't make sense to do the NUA on all of those employer securities. But at least you want to check and give your client full disclosure as to what their options are with those assets.
Do you see Aaron's question?
Aaron says, can you discuss the RMD aggregation rule for non-IRAs again? And do IRA aggregation rules exclude inherited IRAs? Excellent question, Aaron. You can aggregate RMDs for inherited IRAs, but only if they were inherited from the same decedent, right? So if someone has two inherited IRAs, one from Uncle Joe and one from Auntie Susie, those cannot be aggregated. But if they're from the same decedent, they can be aggregated. And they can inherited IRAs cannot be aggregated with non-inherited IRAs for RMD purposes. For non-IRAs, such as a 401k, if you have a client, there are a lot of people who leave their 401ks with former employers and so on and so forth. Those cannot be aggregated. So they have to take their RMD from each employer. Steve says, how about a professor over age 71 that works as wanted needed? They plan to work in 2018, but in May they decide to retire. Should they have to take an RMD in 2017, assuming no work in 2018? But in May 2018, they retire. Okay. Assuming that the plan allows RMDs past age 70 and a half, then this person who retires in 2018, the first RMD is due for 2018. So they have to take an RMD for 2018. And I'm emphasizing for, because the RMD for the first year is due for the first year, but can be deferred until as late as April 1 of the next year. And so the question becomes whether or not it makes sense to take it the first year or wait until April 1 of the next year. And usually comes down to taxes. I say have a tax professional do an analysis with both scenarios to see which one will result in the lower amount of income taxes. And also, if this client is going to roll over an amount to an IRA in 2018, even though ordinarily that person could wait until the following year, April 1, to take the RMD, if they choose to roll it over in 2018, they have to take the RMD before the rollover. So that's a very important rule we want to think about, where clients do have the option to wait until April 1 of the next year. Then if they're taking a distribution in the RMD year, then they have to take it before the rollover. So by rolling it over, they're pretty much giving up the option to wait until April 1 of the next year up to the RMD amount. Excellent questions. Any more questions?
I see Bruce is typing. I don't know if Bruce has a question. See.
Oh, hi, Bruce. Bruce is my friend. Oh my God. What if you're not a 5% owner in the year when you reach age 17.5, but you become a 5% owner in a subsequent year? As you know, another recognized authority, I wonder who that is in this field, so that you can still defer. Do you agree? I want to double check to make sure, but I do remember a rule that says once a 5% owner, always a 5% owner, even if you are no longer a 5% owner. So, Bruce, I think I owe you a cupcake or something like that, because this is the first time I've been asked a question where I can't say yes or no definitively. But that's something that I want to double check. I want to say once a 5% owner, always a 5% owner. If you become a 5% owner later on, then you have to start taking your RMDs, but I want to double check on that. Well, Bruce says I'm correct, so I guess I don't need to check.
Oh, you already knew the answer. Bruce, that's being tricky. Well, we still have some time left, so if anybody has any questions, feel free to pop them in the chat space. I see what you're saying. Betty, did you or Dan? Did you or Dan have any more questions at all for Denise? I just wanted to ask. I've unmuted you.
Nope, I didn't have anything else. I just know that there's so many different situations, and as Denise said, I've been on many of her webinars in the past, that the different situations are just, there's just so much there, and it's not as simple as we may think it is as financial professionals, which is why we wanted to have her on today. Because a lot of times you don't know what you don't know.
True.
Art wants to know, can we print the slides? Absolutely, Art.
Great. I will upload everything afterwards. I'm going to upload the recording and the slides to FPA Connect under Retirement Planning Knowledge Circle. So those will be there momentarily. Denise, did you have anything else that you'd like to share before we wrap up today?
Well, you know, I wanted to add qualified charitable distributions to the list, and since we have a few minutes, I just want to talk about that pretty quickly. Qualified distributions qualified distribution is a provision that allows individuals to donate up to $100,000 from their IRAs and have the amount be treated as a tax-free distribution. Now, a QCD, a qualified charitable distribution, can count as an individual's RMD. So if your clients say, my RMD is $10,000 for the year, I want to make a QCD, they can use a QCD to take the distribution, donate it to the charity, and it wouldn't be taxable, providing that is the first distribution that's done for the year. I'm mentioning this because I know there are a lot of people who want to do the QCD this year and want the QCD to count as their RMD. If that is your client's objective, have them do the QCD first, because if they have already taken their RMD amount, that RMD amount is not rollover eligible, and if they still want to do the QCD, that's going to be an additional distribution. Now, Betty mentioned retirementdictionary.com, which is my free online dictionary. I have a list of the requirements that must be met in order for a distribution to be treated as a QCD. So if you're having that conversation with your clients, just make sure you check all the boxes, one of them being the client has to be at least age 70 and a half on the day that the QCD is done. So let's say you're meeting with your client today, Thursday, and the client says, I'm going to be 70 and a half on Monday. I want to do a QCD. You have to say to your client, you got to wait until Monday, because many people confuse this with the RMD rule. That's that age 17 and a half RMD rule that says in the year in which you reach age 17 and a half, you're subject to an RMD. So they think that applies to QCD because QCD sort of ties into the RMD, but that's not the case. With the QCD, it's different. You have to be at least age 17 and a half on the day that the QCD is done. Now, QCDs can be done from inherited accounts as well, so that's good for beneficiaries who are charitably inclined. But again, if you need to know what the full list of requirements are, they're available on retirementdictionary.com, or you can send me an email.
Excellent. Thank you so much, Denise. This was great, and as Betty said, I think we could keep going with all the different scenarios that we could possibly think of.
Yeah, there's one more question, if I may.
Sure.
Aaron says, so if a client turns 70 and a half in November, but has taken distribution the first half of the year, the QCD is ineligible because it's not the first. No, actually, no. The distribution that he took in the first half of the year is going to be his RMD. He can still do a QCD, right? And that's going to be non-taxable. So let's say the RMD is $10,000. He took it in January. That's going to be a taxable distribution. Then if he wants to do another $10,000 as a QCD, he can absolutely do that. But, you know, had you met with him earlier in the year, Aaron, you could have said, do you want to use your RMD for your QCD? Just take that $10,000 now and donate it to the charity, and that's going to be a non-taxable distribution. So the QCD will always be non-taxable. The question is, how do you make the QCD your RMD as well? So you use the QCD to satisfy both requirements. And the answer is, you got to do the QCD before any other distribution. So he still can do it. You're welcome.
Great. Let me just check and make sure. Did anybody have any follow-up questions? Just thought I'd check and see. Nope, I think we're great. Betty says, thank you, Denise. Lots of exclamation points. Thanks again, Denise. I really appreciate it. I really value all the expertise you've brought to us today. And thank you to everyone who joined us and with all the great questions you had. So have a great afternoon, and we'll see you all again soon. Thanks, Denise.
Thank you.
Thanks. Bye-bye.